Good morning, everyone, and thank you for joining our weekly market review. The week ending September 13th was a pivotal one, defined by a fascinating divergence in the markets. Large cap stocks, particularly in the technology sector, rallied strongly on rising hopes for a Federal Reserve rate cut. However, this optimism wasn't universal, as small cap stocks lagged over concerns about a potential economic slowdown. Today, we'll unpack this divergence, explore the major stock-specific stories in M&A, and review our portfolio's performance, and look ahead to the critical Fed decision this coming week. Looking at the numbers, you can see the split I mentioned. The S&P 500 gained a solid 1.6%, and the tech-heavy Nasdaq 100 outperformed with a 2.0% gain, notching record closes during the week. In stark contrast, the Russell 2000, which represents small-cap stocks, finished slightly down. This wasn't a broad, risk-on rally. Instead, we witnessed a flight to quality growth. Investors channeled capital into established technology companies, seeing them as both safer and more attractive in a lower-rate environment. Simultaneously, they shied away from smaller, more cyclically sensitive companies that are more dependent on robust economic activity. So what drove this sudden conviction in a rate cut? The catalyst was last week's unexpectedly weak labor market report, which showed only 22,000 jobs added in August, far below estimates. This pushed the unemployment rate to 4.3%, its highest level since 2021. If you're a data-dependent Fed, this was a crucial signal. With inflation data remaining stable and employment data now clearly weakening, the market's belief is that the Fed has the justification it needs to begin an easing cycle. As of Friday, futures markets were pricing in an overwhelming probability of a quarter-point rate cut at this week's meeting. The market's enthusiasm was supercharged by a stunning announcement from Oracle. The stock experienced its biggest single-day gain since 1992 after revealing its remaining performance obligation, a measure of future contracted revenue, had swelled to an incredible $455 billion. This was driven by massive AI infrastructure deals, including a reported $300 billion five-year contract with OpenAI. This news single-handedly validated the immense capital expenditure flowing into AI and provided a powerful tailwind for the entire tech sector. The other major story was a speculative frenzy in the media sector. Reports emerged that the newly merged Paramount-Skydance is preparing a takeover bid for Warner Bros. Discovery. The prospect of creating a new streaming and content powerhouse to better compete with giants like Netflix and Disney ignited the market, sending Warner Bros. Shares soaring over 56% for the week. Of course, it wasn't good news for everyone. Synopsys, a semiconductor design software company, plummeted after reporting disappointing results and cutting its guidance, citing geopolitical headwinds and customer issues. Online pet supplier Chewy fell despite meeting estimates. The market had priced in perfection, and merely in-line results were punished. And SolarEdge declined amid new competitive pressure and policy uncertainty for the renewable energy sector. These sharp, divergent moves highlight the market environment we're in. The S&P 500's forward price-to-earnings ratio stands at 22.5, significantly above its 5- and 10-year averages. This leaves very little room for error. It has created a show-me environment where flawless execution is demanded, and anything less, as we saw with Chewy, is met with a swift sell-off. The week's sector performance tells the story perfectly. The expectation of lower interest rates created what we call a barbell effect, lifting two very different sectors for related reasons. On one end of the barbell, the growth-oriented technology sector surged 2.8% as lower discount rates boost the valuation of future cash flows. On the other end, the defensive, high-dividend utilities sector rallied 2.2%. As Treasury yields fell, the stable dividends from utilities became a more attractive source of income, causing capital to flow into this bond proxy sector. Meanwhile, cyclical sectors like industrials and materials lagged, as the same data fueling rate cut hopes also signaled weaker economic demand. The economic data this week supported the Fed pivot narrative. Both the Producer Price Index and the Consumer Price Index came in line or slightly softer than expected, providing further evidence of easing inflationary pressures and giving the Federal Reserve more room to focus on the weakening labor market. Shifting to the global stage, geopolitical risks continue to add volatility, particularly in energy markets. Crude oil prices were caught between fears of a supply glut and the reality of ongoing conflict. A Ukrainian drone attack that suspended loadings from a major Russian port served as a stark reminder of the vulnerability of energy supplies, keeping a significant risk premium embedded in oil prices. This all leads to the main event for the week ahead, the Federal Reserve's policy decision on Wednesday. A quarter-point cut is fully priced in. Therefore, the market's reaction will hinge entirely on the Fed's forward guidance. We see two primary scenarios. The bull scenario is a dovish message. The Fed cuts by 25 basis points and signals that more reductions could be on the table to support the expansion. The bear scenario would be a hawkish cut. They deliver the cut but signal it's a one-off insurance move, stressing that the fight against inflation isn't over. This would severely disappoint the market and could trigger a sharp reversal. Beyond the Fed, we'll be watching key reports on retail sales and manufacturing. We also have a few important earnings reports on deck. FedEx will give us a read on global trade. General Mills will offer a look into consumer health, and Lennar will provide a crucial update on the housing market. Now, let's turn to our value-aligned portfolio. The VAP posted a gain of 0.60% for the week. While positive, this did lag the S&P 500's 1.6% return. This week's performance is a clear illustration of the dynamics of our concentrated strategy. Let's dig into the drivers. Our top contributors were perfectly positioned to capture the week's biggest themes. The portfolio was led by our semiconductor and AI-related holdings, including Tesla, which surged nearly 13%. Tesla benefited not only from the risk-on sentiment, but also from significant bullish activity in the options market and positive narratives around its ancillary businesses like the Optimus robot. Our semiconductor cohort, Broadcom, NVIDIA, TSMC, and AMD all rallied strongly in the wake of Oracle's blockbuster results. Oracle's massive order backlog confirmed the enormous ongoing investment in AI infrastructure, which directly benefits this entire ecosystem. Broadcom was a particular standout, having recently reported its own AI revenues surged 63% year over year, with a record $110 billion in bookings driven by AI demand. On the other side of the ledger, our largest detractors were exposed to the macroeconomic concerns that worried the broader market. Accenture declined on fears that a slowing economy could lead to a pullback in corporate IT spending. Interparfums and SiriusXM were caught in a rotation away from consumer-facing names, and NXP Semiconductors underperformed its AI-focused peers due to its larger exposure to the more cyclical. This brings me back to the nature of a concentrated portfolio. The outsized performance from our AI-related holdings was unfortunately offset by the drag from holdings exposed to these less favorable macro crosscurrents. It's a textbook example that in our strategy, avoiding the significant losers can be just as critical to relative performance as picking the biggest winners. So, to wrap up and look ahead, the market's next move will be dictated by the Federal Reserve. The key sectors to watch will be technology, which is most sensitive to the Fed's tone, financials, which will react to the impact on the yield curve, and the AI stocks to see if their powerful momentum can be sustained. Our investment implication is that while a dovish outcome from the Fed would validate the recent rally, a hawkish surprise could trigger a reversal. Portfolio positioning must remain balanced to account for both possibilities. The three key takeaways from this week are it was a narrow rally, driven by tech and AI, not the broad market. A Fed pivot to rate cuts is now the market's base case expectation, and the stakes are high. Elevated valuations mean there is little tolerance for disappointment, either from companies or the central bank. The week ahead will be defined by the gap between the market's high hopes and the Federal Reserve's actual delivery. Our job is to navigate that gap. Thank you.
Hey folks, sorry for the interruption. Scan that QR code right now. Subscribe and hit the bell so you never miss our market, retirement, or tax smart updates. Go ahead, scan it. I'm going to leave it up there for a couple of seconds more. Scan it. Go ahead. Thanks, really helps.